Okay, the era of hyperspeed, completely unchecked software growth, yeah, it's officially dead. Welcome to the 2026 SaaS collapse. If you've been watching the tech sector even a little bit lately, you know something is fundamentally broken underneath the hood of the companies we all rely on every single day. In this explainer, we're diving deep into the SaaS magic number collapse. We're going to figure out exactly why your favorite software tools are getting so much more expensive, why enterprise tech is basically in a tailspin, and why these once unstoppable startups are suddenly scrambling just to survive. We're going to decode the exact metrics investors are sweating over right now. Let's get into it.
Right out of the gate, we are looking at a brutal 40% drop in SaaS index performance over a seriously volatile 6-month period. I mean, this isn't just a minor market correction or some temporary dip, right? It's a massive structural shift in how the global market values software companies, period. To put this total free fall into perspective, the broader tech indexes only saw a 15% drop over that exact same period. So the market is sending a really clear, frankly painful message to founders everywhere. Investors are totally done tolerating cash-burning machines. That whole 2021 playbook of just buying growth with endless cheap capital, yeah, it's burning to the ground as we speak.
Welcome to the SaaS apocalypse. We're seeing massive, totally established legacy players taking absolutely huge hits to their valuations. Workday, down 37%. ServiceNow, down 29%. Salesforce, down 26%. I mean, these are industry titans, and yet the whole grow-at-all-costs era is officially over for them too. A valuation multiple just isn't buying raw, unfiltered top-line growth anymore. Today, institutional investors are demanding real, sustainable, and highly efficient unit economics before they part with a single dollar. So when literal titans of the industry are losing over a third of their value in a matter of months, it really brings up a massive mystery. Why are software companies suddenly spending so much more capital just to maintain their baseline revenue? Seriously, what is causing these once incredible engines of recurring revenue to just stall out? Why are they forced to consume mountains of cash just to keep the lights on and stop users from churning? Well, to figure this out, we've got to look a lot deeper into the underlying math of the industry.
Section 1. Meet the magic number. To solve our little mystery here, we need to introduce our primary suspect. It's basically the ultimate heartbeat monitor for startup health, the SaaS magic number. This is a super simple calculation that tells investors right away if a business model actually works. Think of your software company like a massive vending machine, okay? This metric answers one straightforward question. If I put $1 of marketing spend into this machine, how much recurring revenue pops out the bottom? You just take your net new annual recurring revenue and divide it by the previous quarter's total sales and marketing spend. It strips away all the hype, all the branding, all the vanity metrics, and just leaves you with the raw efficiency of your growth engine.
Now, the threshold here is brutal, but it's crystal clear. A number above 1.0, that means your growth engine is highly efficient. Your math scales beautifully because you're generating more than $1 of recurring revenue for every dollar you spend. Basically, you're making more money than you're burning to acquire customers. But on the flip side, anything below 0.5 is a massive, massive red flag. If you're below 0.5, your acquisition is so remarkably inefficient that you aren't just burning cash, you are literally incinerating it. Companies stuck in this zone, yeah, they are prime candidates for immediate sweeping marketing budget cuts.
Section 2. Anatomy of the collapse.
Okay, so we know how the engine is theoretically supposed to work, right? Let's look at the 2026 data and see what's actually happening. The median customer acquisition cost, or CAC, has surged to a staggering $1,200 per customer. This means companies are now effectively spending $2 just to acquire $1 of new annual recurring revenue. And that cost is actually up 14% since 2023 alone. Just think about that dynamic for a second. You're digging a hole twice as deep as the treasure you're finding at the bottom. It is a completely unsustainable feedback loop for any company that doesn't have an endless supply of VC money to burn through while they wait to break even.
Because of those astronomically high costs, the median SaaS magic number has collapsed to an anemic 0.7. And remember, that was a pretty healthy 0.9 just 3 years ago. With nearly a fifth of all software companies now sitting firmly below that 0.5 red flag territory, we're seeing widespread structural inefficiency across the entire market. You literally just cannot buy your way to growth anymore. Paid channels have become far too saturated, ad fatigue is at an absolute all-time high, and AI-generated spam has cluttered outbound marketing so badly that traditional outreach is barely even moving the needle.
And naturally, all of this inefficiency drags down the private SaaS Rule of 40 score to a median of just 12%. Now, if you don't know, the Rule of 40 is sort of the golden rule in software. It dictates that your annual revenue growth rate plus your profit margin should equal 40% or higher. For a decade, this was the absolute industry standard for a healthy company. But today, with slowing top-line revenue growth combined with these aggressive cash burn rates, a mere 11 to 30% of private companies are actually meeting that threshold. Growth combined with profitability is just incredibly rare today.
Section 3. The culprits. CAC and pricing.
All right, we've thoroughly examined the crime scene, so let's identify exactly what fundamentally broke the SaaS economic engine over the last few years. Culprit number 1, a massive, totally unavoidable surge in paid acquisition channels. This makes the old playbook of just buying your way to hypergrowth completely unviable. I mean, Google ads are up an eye-watering 164% since 2019. LinkedIn ads are up 89%. Plus, corporate buying committees are getting way larger. That means more executives have to sign off on a purchase, which stretches sales cycles out to an average of 134 days. Because of this perfect storm of ad costs and corporate hesitation, overall customer acquisition costs have spiked by up to 60% across the board since 2023. It just takes more time, more people, and significantly more money to win a single new logo.
The second major culprit is the severely outdated per-seat pricing model. This older framework actually punishes a customer's headcount growth and regularly forces them to pay for unused licenses. Picture this, a CFO is auditing their tech stack, right? And they realize they're paying a premium for 200 software seats, but only 40 employees actually log in every day. The rest are basically just digital ghosts draining the company's budget. It's no wonder this rigid model has plummeted to represent only 15% of the market today. Compare that with usage-based pricing, where if your software isn't actively creating value or being used, the customer simply doesn't pay for it. Makes a lot more sense, right?
Section 4. AI native, the efficiency advantage.
Now, amidst all this collapse, it isn't entirely doom and gloom. A new breed of highly efficient, aggressively lean companies is emerging, and they're actually thriving in this harsh environment. By baking artificial intelligence directly into their core operations from day one, AI-native SaaS companies are heavily compressing their operational costs without sacrificing their aggressive growth rates. To really get this, look at the burn multiple, which measures exactly how much cash a startup burns to generate every single dollar of new ARR. Keeping it under 1.0 is considered exceptional. Well, these AI-native companies are hitting remarkable burn multiples of 0.8x to 1.2x. Because they don't need massive, bloated human teams to scale development or handle tiered customer support, they stay incredibly lean, wildly outperforming traditional SaaS companies at pretty much every stage of growth.
And then there's vibe coding. This is a revolutionary AI-driven approach that is flipping the economics of software development entirely upside down. Instead of needing to hire a senior engineer for, 150 grand a year to build a minimum viable product, solopreneurs and agile founders are literally just using natural language prompts to have AI write, test, and deploy the code for them. They're completely bypassing expensive dev teams to prototype up to 5 times faster. It totally democratizes development. A single visionary founder can build, launch, and scale customized tools for under $50 a month in API costs. Absolutely wild.
The most capital-efficient companies are also surviving by aggressively shifting their focus inward. Look at this shift. Expansion revenue from existing customers now makes up nearly half of all new annual recurring revenue. This is a massive pivot. Remember that staggering $1,200 customer acquisition cost we talked about earlier? When acquiring a brand new customer is that punishingly expensive, the absolute smartest play on the board is to unlock more value from the customers who already use and trust your product. Growing your existing base, upselling new features, increasing usage, that's really the only reliable way to bypass those skyrocketing acquisition costs in the modern market.
Section 5. The new rules of SaaS. So how do you adapt your own business to these new realities so you don't become a zombie company just stumbling toward bankruptcy? Well, here is your exact 2026 survival guide. You absolutely must prioritize retention, lightning-fast payback periods, and incredibly strict capital efficiency. First up, you need a net revenue retention above 106% to ensure your user base is actually growing in value without you having to hunt for new logos. Second, your CAC payback period has to be under 12 months. You got to recover those high acquisition costs rapidly before the cash runs dry. Third, your magic number must clear that 1.0 hurdle to prove your marketing actually scales. And finally, you've got to ruthlessly maintain a burn multiple under 1.5x. Guys, this is no longer just a wish list. This is the exact, rigid framework that modern investors are demanding right now.
The era of cheap capital, endless runway, and growth for growth's sake It is completely in the rearview mirror. The market has fundamentally reset. So take a hard look at your own tech stack, your own investments, or your own startup, and ask yourself a really hard question. Are you optimizing for vanity metrics, or are you actually building the efficient, self-sustaining economic engine required to survive the next decade of software? Because I promise you, if you're just burning cash to stand still, the 2026 market will absolutely leave you behind.